Hey, it's Dr. Gold again. We're going to be covering the remaining part of this chapter, which is on market value ratios. And again, those two ratios we'll be covering are the price earnings ratio and the market to book ratio. The price earnings ratio is essentially what the marketplace itself is attaching a value to for that particular investment. So in this case, this company has, that's in the textbook, a price earnings ratio of 14 times, which means that the share price, $32, is selling at 14 times the earnings per share of $2.28. Now, we can get this information relatively easily from Yahoo Finance and other sources. Like here's Walmart, $86.31, and their earnings per share of $4.87. So, again, if you get out your calculator and you type in $86.31 and you divide that by the earnings per share of $4.87, it comes out to a price earnings ratio of 17.7. Is this good? Is it bad? Again, you have to compare things with competitors and their peer group, which, by the way, you can do very easily here on Yahoo Finance. You can go to competitors, and then you can see two of their competitors right here, Costco and Target. And you can see the price earnings ratio here, which we just calculated at 17.7. And you can see that both Costco and Target have higher price earnings ratios, which means that the market, for some reason, is willing to pay a higher premium for the share prices of those companies relative to the earnings per share than they are for Walmart. Now, that could be for a lot of different reasons. It could be that, for example, when you look at the quarterly revenue growth, Costco is growing at more than twice the rate that Walmart is growing at. It could be that because Target has a higher gross profit margin than Walmart, people are willing to attach a more value to that and pay a greater premium as well. I'm just trying to connect some of the dots here for you to show you where the stuff from the textbook is available in real time through websites like Yahoo Finance and so forth. Two notches above competitors on this page is something called Key Statistics. And when you go to Key Statistics, excuse me, there's lots of other data points in here. There are some financial highlights, so it has, again, the gross profit margin and operating profit margin for Walmart. It has the return on equity for Walmart, almost 20%. It tells you what the quarterly revenue growth is. It tells you what their earnings before interest and taxes are. It tells you on the balance sheet how much cash they have on hand. It gives you the current ratio in here. It gives you, on the right-hand side, the number of shares that are outstanding over here, 3.22 billion. And that's important for a lot of reasons because we need that to calculate different ratios. But also, if you just go to the front page for Walmart and you see market capitalization of $278 billion. This is sometimes used as a way of valuing a company. How is that calculated? Well, you take the share price, we can just do it right now. You take the share price of $86.31 and you multiply it by the number of shares outstanding, which we saw on that previous page was 3.22. And you hit equals and you get 277 or close to the market capitalization there. So, these pieces of information are kind of hidden in different locations, but they all kind of pull together and allow you to, really do some amazing analysis relatively quickly and easily. So that's the price earnings ratio. You always want to compare and contrast those with its peers, and it really speaks to and indicates how much investors are presently at this moment in time willing to pay excuse me, for every dollar of earnings that the company has reported. The market to book value ratio is, first of all, the market, they're talking about the stock market share price, okay? So that's like the market price for the stock per share, and it's divided over the book value per share. Book value is basically, the assets minus the liabilities, which gets you the shareholder equity, and then you want to subtract out of that preferred equity or preferred shareholders and just come up with the common shareholder equity and divide that over the common shares outstanding. In this case, this company has a market price of $32. They have a common shareholder equity of $911, and they have 90 million shares outstanding. So when you divide 911 over 90, you get $10.13 per share. And then when you divide that into the stock price of $32, you get a market to book ratio of 3.16. Now, book ratio is very important for many types of investors, like Warren Buffett, for example, who's considered to be a value investor. What a lot of people do is they look at book value and they say, book value is essentially the intrinsic value of the company. It's what's left over after you subtract the liabilities the company has from the company's assets. So if the company were to go into bankruptcy, the question is, what would be left over after satisfying the company's debts through the sale and use of assets that existed? And the answer is the equity, specifically the common equity that's on the balance sheet. So what some value investors will look at is, what is that amount on a per share basis? In this case, it's $10.13. And what they'll say is that's really the intrinsic or actual value of the company under a worst case scenario. And they'll look for stocks that are selling below in the marketplace their book value. Warren Buffett does this all the time. This is really one of the things he has done that has been very, very successful, is he's researched and searched for and will really only buy companies that are typically selling at a discount to their book value. And his thought process is, one of two things could happen. The company could go into bankruptcy, in which case I'll get back my investment that I made, because if the book value is $10 per share and the stock price is selling at $5 per share and the company goes into bankruptcy, well, there's $10 of book value there. I'll get back my money. The other thing he says is, probably I don't want to buy companies that are going into bankruptcy. So what probably will happen is, because this company is temporarily undervalued and is trading below its intrinsic value, as conditions improve and as Warren Buffett goes in and sort of works with management to shuffle things around, he can begin to get the company's share price to move toward or above its book value per share. So those are the two ratios here for the market value ratio section I wanted to cover, and this will be the third and final video for Chapter 4.